welcome to our very special Diwali programming where we have been discussing about stocks, bonds, mutual funds and much more. But today, onto this special episode, we will be talking and telling you about how to grow your wealth exponentially. In other words, discuss about the power of compounding and much more, isn't it, Cheryl?
Absolutely, Shrishti. And given the time that you've seen the markets climb that 20,000 when it comes to Nifty, no doubt we saw a mild correction. We're trying to bounce back from those levels. Remember, also, not just that, you had the small cap and mid cap index seeing a sharp rally, but amidst all of this, how should you protect your portfolio so that you can counter any sort of volatility? What's the right asset class that you should invest in? What's the right asset allocation in the mix that you should actually put your money in? And to get all of that questions answered, today we are joined by Nilesh Shah, who is the MD at Kotak AMC, joining us on the show. Very good, actually happy Diwali to you, sir. Thank you so much for joining us on ET now on the special, very special edition that is Planning Your Goals with Nilesh Shah. And a lot of questions actually arise in one's mind, right? Asset quality. What sort of an asset mix should you have when it comes to your allocation of your portfolio? Those are some pertinent questions that you will answer live on this show from the queries that we've got from our viewers, isn't it?
Well, yes, Nilesh, we will be connecting with our live guest as well. Firstly, festive greetings to you and your family as well. But Nilesh, starting the discussion with, because a lot of our investors watch you every year and they are looking forward to the learnings. But this SAMVAT, what we have seen is that there is definitely day by day investors are getting educated. They are learning more about the markets. And along with that, in other asset classes, we are seeing build up in the real estate investment, that people are looking forward to that. So any correlation you find between building a house with brick, mortar, cement and building a portfolio with different asset classes, any combination that investors can look forward in learning from that?
So thank you, Cyril and Shrishti, for having me over here. Wish all the viewers of ET now a very, very happy Diwali and a prosperous new year. Indians have been investing into real estate forever, and their largest allocation, the largest wealth is in real estate. The same discipline, if they put into equity investments, that will make wonder. I haven't yet seen a person who trades in real estate, buy in the morning, sell in the afternoon. That's a surefire way to lose money. No one does this. There are people, who build corpus for their real estate investments over a period of time. If the same patience is given to your SIPs, you will build a better corpus. Most people, when they invest in real estate, they invest with a view of 10-year and 15-year and 30-year. No one does mark-to-market on a 6 months basis. If they do, they lose money. Please apply the same logic to equity investments, you will make money. So whatever people are doing for real estate investment, they need to do it for equity mutual funds, and probably they'll make far more money than in real estate.
Right, so that's talking about the right asset quality mix up, talking about real estate as an investment. And like you said, a lot of them have been actually investing in real estate as well of late. But this is a special show, like you mentioned, Planning Your Goals with Nilesh Shah. We have actually live viewers connecting with us to ask you questions and get their questions with regards to portfolio answers. So let's actually try and connect with the first viewer. We have Rahul Sharma who's joining us. Very welcome aboard, Rahul. Thank you so much for joining us on ET now, and you are connected with Nilesh Shah. So what's your query?
Yeah, hi. Good morning. Thank you for having me on board. My query to Nilesh is that I am an aggressive investor in stock when it comes to equities. But now looking at my daughter's advanced studies, my target is to have, let's say, around 1.5 CR in the next 10 to 12 years. And I would be investing, let's say, 1 to 1.5 lakhs a month. So would I be able to achieve this target in 10 years? Looking at I'm actually looking at a return of almost 13 to 15% per annum.
Nilesh, what's your view then on for Rahul? What's the right asset mix that he should keep in mind to actually achieve that goal?
So Rahul Bhai, you are investing for a longer term and you are aggressive investors by nature. Uh, I think the amount of allocation which you have made between 1 to 1.5 lakh, that will have to increase over a period of time as your savings increase. To start with 1.5 lakh is good, but by the time you end for your daughter's education after a decade or plus, you should be looking at enhancing that multiple times. Then only you will be able to achieve the target which you have in mind. Second thing, since your time horizon is long and you have aggressive nature of investment, you can consider SIP in equity mutual fund. Go for a diversified mutual fund rather than sectoral or thematic mutual fund. A blend of large and mid cap or a multi cap will be more appropriate for you. As you reach towards your target, maybe year or two before that, book your profit in equity mutual funds and move into balance advantage fund kind of thing as your time horizon shortens. So 3 things: keep on increasing allocation to your SIP in equity mutual funds over a period of time. Second, 1 or 2 years ahead of your D-day, please move from equity to balance advantage fund kind of thing and choose a large and mid cap fund or a multi-cap fund so that your risk profile and time horizon matches. I wish you all the very best for your daughter's education.
All right, I hope, Rahul, this suggestion by Mr. Shah will help you actually reach your financial goals. But Mr. Shah, let me ask you one very pertinent question, okay? And this is related to the person that I am also. There are a lot of them who want to achieve very high growth, high return, want to aggressively invest. But the problem is that they are very risk averse. They are scared to invest, put in big money, take that big risk and the bet. What sort of an advice would you give a person like that, or for me also personally, what sort of an advice would you give the person? How can that person actually meet the goals of getting high returns and yet be able to mitigate the risk? What sort of a mindset do you need actually to change that risk-averse pattern?
So there's no free lunch.
Right.
Risk and return go hand in hand.
Yeah.
I did a skydiving in Australia many years back. When I was pushed out of the plane, and it was a tandem dive, I was scared to the hell. I thought I'm dead now. I was falling like a stone. But after 2-3 seconds of fall, I realized that I was in tandem dive. There is an experienced person on top of me, and I might as well enjoy. Once you get that realization, the fear was gone. And I still have that video where I could see fear on my face when I was thrown down, and then how I was enjoying once I realized that, okay, I'm in safe hand. Investment is also like that. Risk is what you don't know. But when you know that in COVID period, markets have corrected, but this will also pass. It was the greatest opportunity to make money. So I think knowledge and wisdom will remove the fear of risk, and hence you will be able to make your return.
Okay, that's always great to hear and learn from you, Nilesh. But with this, let me go across to our second viewer that we have, because this is the special opportunity that we are giving them to ask their queries live from you. And the next viewer is actually Arun Bharti. Arun is live with us. Hi, Arun. Please go on. We have Nilesh with us live.
Hi, good afternoon. Thank you for having me on ET Now. Festive greetings to Nilesh, ET team, and the viewers of ET. So we always talk about portfolio diversification, and we have recently seen last month there was so much instability in the market, maybe because of US yields, the other factors, the Gaza war and all. So that is one of the cases, but still there is instability in the market. My question is, how do you keep our investment safe and portfolio growing? So I understand the markets, this investment subject to market risk, and based on such instability, what should be the ideal percentage of investment in debt, equity? If you could guide us, what should be the ideal percentage of investment in the various portfolios.
Like Nilesh, continuing with what Cheryl was asking, that risk as well as returns go in tandem. But the point, asset allocation, that is in the mind of a lot of viewers. We had your take regarding real estate and equities, but with respect to different asset allocation, how should they go about it?
So in asset allocation, always remember one rule. When life gives you lemon, you make lemonade out of it. Do I have any control over what will happen in Middle East? Do I know what's going to happen in Russia, Ukraine? Can I predict what Fed is going to do? Will I know whether corporates will give good results or bad results? I mean, all these uncertainties will continue to come and go. I don't have control over events, but I have control over myself. So when COVID happened and markets corrected, I lost money. But that was an opportunity to buy. So you become overweight equity. Today, as we speak, markets are fairly valued. So I should be equal weight equity. If for some reason market goes berserk and becomes overvalued, I'll book profit. If for some event market falls, I will put more money and become overweight. So essentially, Arun bhai, you'll have to control your reaction, which is in your control. If there is opportunity, become overweight in that asset class. In very simple terms, you have to look at portfolio which delivers better return than inflation, then your wealth will continue to grow. And to do that, you have to buy what is cheap and sell what is expensive. When you do that strategy, in the short term, there is pain because you are catching falling knife. You will be booking your profit early in the shorter term. But that strategy of buying cheap and selling expensive, that will create wealth over a period of time. The thumb rule is that 100 minus your age should be your allocation to risk assets. Now let's say you are 50 years of age, 55 years of age, then 100 minus 55, 45% should be your allocation to risk assets. But if you are aggressive, then 45 can become 65. If you are conservative, then 45 can become 25. But that 25 is not constant. In COVID, 25 should become 45 and 65 should become 85. So you make those kind of adjustments whenever opportunity comes. Make lemonade when life throws lemon at you.
All right, that's a key takeaway. When life throws lemons at you, you should instead not even think twice, but go ahead and make lemonade out of it, is what Mr. Shah has to say. But on that note, we'll actually slip into a break on this special Diwali edition of Planning Your Goals with Nilesh Shah. When we come back, there's lots more to chat about on how should you adjust your portfolio to manage risks in the market as well as elsewhere. So don't go anywhere. Welcome back. You're watching the special Diwali edition of Planning Your Goals with Nilesh Shah. A short while ago, we had viewers who joined us live on the channel. Now we have some of the queries actually that are pouring in via our WhatsApp number as well as on our social media platforms. Mr. Shah, there is one query particularly that's come in. In fact, I would like to take the initiative to, because when you talk about charity, charity begins at home. When you talk about markets, investing, there are a lot of people who actually work with us at a very young age. We have someone who's known as Shawnee, who's a producer, budding producer, who is just 25 years of age. And she is very much interested in securing her future. But the problem being is the question that arises in everyone's mind, what's the right asset quality? Should I put all my eggs in one basket? Should I be only investing in equities and neglecting other asset classes? For someone of her age, who's 25 years of age, also if gender matters, she's a female, what sort of a risk, profile that she should actually keep in mind while investing in these asset classes to make her future secure?
So I'm making some assumptions. First, my advice will be that income minus expense to savings, don't follow that. Follow income minus savings equal to expenses. So get the habit of some savings no matter what your salary is. Second, do regular investment. little drops of water will make an ocean. One pav bhaji which you don't eat, one movie which you don't see will eventually create your retirement corpus. Third, follow a disciplined asset allocation. Don't put all eggs in one basket. If you are busy, if you don't have time, there is asset allocation fund available where fund managers will divide between debt, equity and gold, and it can still provide you financial security if you give the time. And finally, be a long-term investor. You are in the Amrit Kal of India. You are the luckiest generation. Your savings will grow when India is rising. Don't miss the opportunity.
Right. Well, always great to learn from your perspective, Nilesh. But before we let you go, what we have seen from you is that you always have those one-liners coming in, because in this market volatility, where in just 2 weeks back we had that selling trot, and good to see that the festive cheer is definitely on the Dalal Street. But given the market time that we are sitting in, any one-liner that you have from Ramayan maybe where investors can relate to and which can definitely boost their confidence?
So in Ramayan, Lanka was made of gold. There was no reference to Ayodhya of being gold. So it's fair to assume that Lankans were rich. How did they become rich? My hypothesis that Lankans were investors. They used to invest and like Kumbhkarna forget for 14 years. That made wealth for them. So please be Kumbhkarna kind of investors. Invest in quality today and wake up after 14 years to see how it has grown.
Right. Mr. Shah, everyone knows you are a huge cricket fan. Shrishti was just mentioning that she also read a tweet as well on yesterday's stunning match that was underway. But let's talk about cricket matches and the different format that you have in cricket matches. You have one day, you have test series, you have T20 as well. Can you draw an analogy between these formats and different investment horizons that one should keep in mind? What sort of asset allocation should one keep in mind?
So if you are doing trading, then it is T20. Their discipline becomes critical, stop loss becomes critical. If you are doing investing, it's test match. Even if you let go a few balls in the beginning, doesn't matter. Your time on the pitch will make you more run than timing, the pitch or timing the bowling. And I will also say there's something called gully cricket, especially in cities like Mumbai, where there are no rules. If it is my bet, I won't be given out. That's like the, Ponzi schemes and cryptos and gaming and those kind of things. Don't go over there. Don't go into dabba trading. There the rules will favor people who have the bat and ball, not you. So stay in the T20 one day and test match. Don't go and play gully cricket.
But something related to Nilesh, what Cheryl was talking about, the cricket theme. So in cricket, we have the captains and the coaches who lead the team. Though in investing, we don't have that. We actually have that the choice to go ahead and choose our financial advisor. So how should one decide their captain who can lead their investment journey, and any factors that you believe that they should look out for when choosing a financial advisor?
So it's very simple. You go by your experience. If a person, a financial advisor is selling me a product, then he or she is not a good advisor. If he is understanding my risk profile, giving me a complete solution and building a relationship, from transaction to relationship, he or she is your best advisor. And there's nothing better than experiencing it. If I know a person handhold me in March 20, that's the best thing. And I'll give you a small incident. I was in Jaipur where I met a financial advisor, a mutual fund distributor, whose client, a 75-year-old lady, had X amount of money in debt mutual funds and hybrids. And at the bottom of the market, she shifted that into equity, partly on her own initiative and partly advice of the mutual fund distributor. Today it is 4 times more than that. Imagine what you earn for 75 years. You have multiplied 4 times by timing it in just one good advice.
Absolutely. And that's talking about the good advice coming in, sound decision, knowledge, wisdom, all of them actually work hand in hand when you're investing in the market. But Mr. Shah, you must have come across a lot of them who've actually not made a sound advice based on certain misconceptions or certain pitfalls that they have actually come across. Are there any misconceptions that you've come across time and again when it's there in an investor's mind, one that should someone be wary about right now while investing in the markets?
So there is a Hindi proverb which says that जितना चमकता है उतना सोना नहीं है. When something is too good to be true, assume that it is not true. A lot of people have lost money because they put their faith on someone who was misleading them. इतना रिटर्न तो आ ही जाएगा, मैं बैठा हूं ना, आप यहाँ पे निवेश कर दीजिए. No, ask questions, take right explanations, and if you get convinced that yes, there is a right explanation, then only go and invest. Trust, but verify.
But Nilesh, this SAMVAT 2080, and we have been getting you and talking to you every year and looking forward to your advice. Anything different this SAMVAT that you believe that over the years this is something different, or this is rather something new that you are looking in terms of the trend, in terms of the investor confidence or the education that they have? It could be either in a good sense or in a bad sense, because we have seen so many news around regarding that. So what's your take on that?
So I wouldn't say one SAMVAT to another SAMVAT, but let's say 10 years before and today. Okay. One, conviction about India growth story is almost universal. Second, investors have matured thanks to the mutual fund distributors and channels like ET Now, which has imparted financial knowledge. And third, I think we are at a stage where every corrections will be bought because of the conviction. Earlier it was momentum, now it is conviction. That's the biggest change in the investor behavior.
Right. What's amazing is the fact that we are getting some of the queries live, and there's one query that is coming from a senior citizen. Since you actually spoke and gave an example of a senior citizen a short while ago, we have Dhanlakshmi, who is actually 75 years of age. She's saying that she's a retired teacher. She had her corpus, and right now, just like all the youngsters, she's also trying to actually dabble into the markets. She has some investments. She's making some profit in some of them, and a lot of them is in loss because she did invest in some of the penny stocks. So that's where she's lost out on her investment. She wants to know now, at an age of 75, what sort of an asset quality mix that she should keep in mind? Do you think that equity is the only place that she can invest in right now, or should she go into other asset class as well?
So at 75 years of age, my recommendation will be to have minimal exposure to equity and more exposure to fixed income. Second, as a teacher, I'm sure she will be getting pensions, so some part of her regular income is there. But for the balance portion, she should be looking at systematic withdrawal plan from a conservative debt hybrid scheme or a balance advantage fund or an asset allocation fund. My recommendation will be not to go into penny stocks. It may give you short-term gain, but eventually it will give you long-term pain. So don't dabble in market, invest in market, don't go towards penny stock, and supplement your pension income with systematic withdrawal plan from a debt hybrid scheme, asset allocation fund or balance advantage fund. Your portfolio should be tilted towards fixed income and safer assets compared to equity.
Okay, so that's the advice. But Nilesh, great to have you. With this, we would like to wrap this special edition of Planning Your Portfolio with Nilesh Shah. And thank you so much for joining us today live in the studios and enlightening all our viewers in this Diwali special programming. Always great to have you.
Thank you for having me over here, and wish everyone a happy Deepavali.